We're getting close to the end of 2025, and the asymmetric portfolio is up 40.5%, more than doubling the performance of the S&P 500. So today I want to go through 5 things that have really driven that performance. These are the frameworks, the fundamentals that I use to invest. And in this portfolio, I'm investing relatively simply. I'm buying stocks once a month. I buy stocks at the beginning of every single month. If you want all my deep dives, I call them spotlight articles. And once I do a spotlight article, then a stock goes into the asymmetric universe of stocks, and I pick from each of those stocks once a month. It's a relatively simple way to invest, but it's very effective long-term. So there's 5 principles that I use for finding those stocks and for investing each month. I'm going to go through all 5 of those today. One of them is simply looking for asymmetric opportunities. This means what are those opportunities that are 10x, maybe even 100x in size over the next 10 plus years. I'm not necessarily looking for a stock that is undervalued by 20 or 30%. I want companies that are going to disrupt the industries that they're in over a long period of time. That's how you find companies like Amazon, like Netflix, like Tesla. And those are the kind of stocks that are going to provide outsized returns over a long period of time. And that gets to number 2. You have to hold stocks for a long period of time if you want to have these outsized returns. For a stock to go up 10x in value, you have to let it go up 50%. You have to let it double. You have to let it 5x in value. It takes a long time for that compounding to work. But if you're able to do that, if you're able to own these stocks that end up being really disruptive in their industries, just buying and holding is the right strategy. Number 3, you have to follow fundamentals, not fads. I'm not investing in quantum stocks, for example. I'm not following this nuclear energy fad. I'm buying companies that are growing their revenue. I'm buying companies that are disrupting the industries that are in. I want the fundamentals, the income statement, the balance sheet to tell me that these companies are performing and doing the things that I think they should be doing long term. Just because a stock is popular does not mean it's an asymmetric investment. That has really been key to my success, is staying away from those areas of high volatility. Because if fundamentals don't back up your thesis, then it's not going to be something that's sustainable long term. Number 4 is you have to let that compounding work. Let revenue compound. Let net income compound. If a company is buying back stock, you have to let that work over time. That's another thing that takes time. It takes a long time to even understand how compounding works. But once you look back on a company that is able to compound revenue at 20, 30, 40% over a long period of time, that's how you get those outsized returns. And the biggest thing with asymmetric investing is you have to embrace uncertainty. I am not going to be right about every single stock that I cover here on Asymmetric Investing or every stock that I buy for the asymmetric portfolio. But over time, if I'm following these principles, even the stocks that I get wrong are going to basically become irrelevant in the portfolio because those gains are going to outweigh any losses in any stock that I'm wrong in. So those are the 5 things I'm going to go through today. And I'm going to show you some examples of how these have worked in the portfolio. My name's Travis Hoyam. Thanks for watching Asymmetric Investing. Don't forget to subscribe here on YouTube. And also, like I said, my newsletter. I also am going to be using Fiscal AI throughout this video. Fiscal AI is the best research tool that I have ever used. I'm a paying subscriber. And right now, they're doing a sale over the next couple of days for 30% off. So you can get 30% off on any of their plans. And the great thing about Fiscal AI is it has all of the information you need all in one place. Let's look at Spotify. This is one of the biggest holdings that I have in the asymmetric portfolio, but you can see all the company statistics you need, charting of what's going on with the stock price. They actually upgraded this just in the last 24 hours. So they keep making this platform better and better, but all their financials are here. But here's the real key, the key performance indicators. So if you want to look at what does premium revenue look like compared to ad-supported revenue, you can just make a really nice looking chart. You can even stack these things together. And maybe you want to add in something like the premium subscriber base and the ad-supported subscriber base. That way you can start to understand what's the drivers of the business long-term. So all this is on one platform. You get everything in investor relations, all their earnings transcript, all their slides and earnings reports. All of this is in one spot. It's made my research so much easier as an investor. So if this is something you've been eyeing, now is the time to do it. 30% off at fiscal.ai/ASYN. So let's dive into these 5 factors that I look at long-term. The first thing is going to be the upside opportunity for the investments that I'm making. So asymmetric potential. What am I talking about? Well, Robinhood is a good example of that. Robinhood is actually my biggest position right now in the asymmetric portfolio. That's in large part because of this chart right here. Over the past year or so, shares are up about 300%. Shares are up about 600% since I originally invested in Robinhood. And the potential here is that they're going to disrupt the financial services industry in a number of different ways. So I'm going to use these KPIs to show exactly what I mean. Now, when you look at Robinhood, you may think of the company that we knew in 2021. So 2021, a bunch of their revenue was from options trading, almost half of their revenue, actually. Then you had cryptocurrencies, a little bit less revenue in equities, and then other transactions. So if you look at their revenue today, they're making much more of their money from things like net interest revenue and a lot of fee-based revenue from things like their credit cards, the Robinhood Gold credit card. And what they're doing is expanding their wallet share. So that's what they talk about, is that they don't want to just be your brokerage. They want to be where you're now doing your banking. That's something that they recently rolled out. I have a credit card with them. They've moved into prediction markets. So there's all kinds of ways that they can expand kind of horizontally. Then you have geographic expansion. You have product expansion, lots of different ways that Robinhood could grow. So when I originally covered Robinhood, this was a company that was a little bit unloved by the market because they had gone through that big drawdown after 2021, 2022. They kind of hit highs, and then the trading actually kind of dried up. But the idea was their strategy was right. It is much, much easier to use Robinhood's app than it is to use something like Wells Fargo. That's another account that I have. I would much, much rather interact with Robinhood and invest on Robinhood than with Wells Fargo or with Charles Schwab. Just a much better experience. And so as younger investors move up, start to invest more, start to invest in retirement, start to spend more on credit cards, these are all things that are going to be tailwinds behind Robinhood. That's that asymmetric opportunity. As they're able to grow into all of these markets, they're going to be able to grow revenue. They're going to be able to grow net income. And when we talk about following the fundamentals, that's exactly what you see with Robinhood. Revenue is growing like crazy. I'll add in the revenue growth rate here. You can see revenue growth rate over the past year, 75%. Most recent quarter was actually 100% revenue growth. And they have operating leverage working in their favor. Net income, free cash flow, both positive now, something that's really turned around. Another company that I covered at a very similar time was SoFi. Sort of a similar story, digital first platform, trying to disrupt the traditional banking industry. They're more in things like loans. So a little bit different start from Robinhood, but you see them moving into a lot of the same products today. So they're moving into things like cryptocurrencies. Can they disrupt the payment industry? That's exactly what I want to see, is those opportunities to go into a market and say, you know what, we're going to look at things a little bit differently. That's how we're going to grow. That's how we're going to see a 10x opportunity. And by the way, our financials are going to show more operating leverage because we don't have to build bank branches. We don't have all of the infrastructure costs that you have in a traditional banking industry or traditional brokerage industry. That's what's ultimately going to drive those 10x returns. That's just a couple of examples of thinking asymmetrically. Let's go to number 2, and that's holding stocks for a very long period of time. This is the stock chart of Spotify since I originally invested or did the Spotlight article for asymmetric investing. So you can see that shares are up 343% since then. But this has just been sort of a steady grind higher. There hasn't been anything specifically that has happened. It's just been a slow and steady improvement in their financials, slow and steady expansion of their multiples. So let's look at a couple of these things, because these are typically things that happen slowly over time. You can see here's premium revenue. I'll go to the trailing 12 months because this gives a little bit better idea. This is since the end of 2022. And you see that there's no single quarter where things really jump out. But this is expanding the number of users you have. That's what these 2 lines here are. So the orange is going to be the premium. That's really where they're going to drive most of the revenue. That continues to go higher quarter after quarter. They're also raising their prices. So that's where you're going to see a little bit of growth in that premium side. You have to let these things work out over time. You go into investment having a thesis, and then if management is able to show that they're able to do those things quarter after quarter after quarter, eventually the market is going to realize, you know what, this is a really good company. You don't necessarily know when that turning point is going to happen. You may have a stock like Alphabet. I've been building shares of Alphabet for about a year and a half now. It's just been in the last few months that the market has gone, you know what, this is a really great company. Shares are up about 100% since April. I'm not trying to time the market long term. So as an asymmetric investor, I think these companies are going to do really well over a long period of time. But I don't know when the stock's going to go up 100%, maybe 200 or 300% in a year. So I'm going to be building these positions slowly when I think the valuation and the multiple is reasonable. And then eventually, when the market does decide that it's time to push the stock higher, expand those multiples like it has with Spotify over the past couple of years, I'm able to ride that long term. Number three, we got to follow fundamentals, not fads. Like I said, I'm not investing in things like nuclear energy right now or quantum computing. I am investing in companies that are compounding their revenue. This is On Holding. This is a great example. 40% growth per year over the past 3 years. You go back 5 years, we're talking about 54% growth. But look at what's happened with the stock over the past year. Shares are down 26% over the past year, but their financials continue to get better. This is their revenue, just continues to compound year after year. Let's look at the trailing 12 months. No real blips in this. The other great thing for them is their net income continues to grow. This is despite the fact that this is a hard goods company. It's very difficult to be profitable when you're growing at 30, 40%. But On Holding is doing exactly that. And they've shown that they have pricing power in the market. Now, again, like I talked about with holding long-term, I think I'm buying at a really reasonable price today. And eventually, I think the market will realize, you know what, this is a company that continues to compound their revenue. They do have that pricing power. They're able to generate free cash flow. This stock should be trading at a much higher valuation than it is. It's going to be next month, next year, but I'm happy to buy shares at a reasonable price. And then eventually when those fundamentals show that they're not just a one-time thing, that's when the stock is going to move higher. So got to follow those fundamentals, not fads. Now, when we talk about letting compounding work for you, I'm going to actually go to a stock that I don't have in the asymmetric portfolio. This is Amazon. Let's actually go back to the maximum. This is the drawdowns for Amazon. So basically, when a stock hits a peak, how far does it fall from there? And you can see, go back to 2003, shares fell 55% or so. 2009 fell 65%. There's a whole bunch of times throughout history that shares have fallen 30, 40%. But if you just let this compounding work for you, look at this number, 53,000% increase in the stock. And that's because Amazon has been able to compound their revenue and ultimately their net income over that period of time. This is going back 20 years. On the enterprise version of Fiscal AI, you get 20 years of data. So you can see that the compound annual growth rate, 25%. Now, there's a lot of companies that if you grow 25%, maybe the market's even going to be disappointed. But if you're able to do that for 20 years, that compounding is eventually going to work in your favor. So you can go back through almost any company that has been a massive outperformer. Amazon, Apple, Netflix. These are all perfect examples of just letting that compounding work for you over a long period of time. Axon is actually one of my biggest holdings in my personal portfolio. It's gotten really expensive, but that again is just a stock that has compounded revenue 30+% for about the past decade. So letting that compounding work for you is ultimately the way to drive long-term returns. Finally, you have to embrace uncertainty. Like I said, I'm not going to get every call right. Virgin Galactic is actually a company that I covered on Asymmetric Investing. I still think it is a really interesting company, potentially disruptive. Just the idea that going to space is going to be something that happens on a relatively normal basis. But over the past 3 years, shares are down 96%. This is a stock that continues to be in the asymmetric portfolio. And guess what? It doesn't matter. That's because I have companies like Robinhood and Spotify and SoFi in the portfolio. Those gains from those companies outweigh any losses that I have from Virgin Galactic. You have to lean into the fact that the only amount of money that you can lose in any investment is the amount that you put into it. But the upside potential of being an equity investor, a stock investor, is unlimited. So a stock can go down 100%, but it can go up well over 100%. You have to lean into that potential to be able to beat the market. That's something I'm doing on Asymmetric Investing. So like I said, if you want to know exactly what I'm buying every single month, check out my newsletter, Asymmetric Investing. There's a link on the screen and a link on the show notes. And if you are interested in what you saw here with Fiscal AI, fiscal.ai/ASYM, 30% off. That's only through Monday. So there's a limited time offer. They only do this sale twice a year. So this is the time to get it if you've been eyeing Fiscal AI. But let me know what stocks have been driving the outperformance in your portfolio. Are you up over 40%? Leave those comments in the comment section below. Thanks for watching, everybody. We'll see you here next time.